Hello and welcome to Gold and Silver Assets. It's Sunday the 21st of June 2020. Today we're going to look at the anatomy of bubble, tops and pops. Now the reason that we're going to be looking at this is because I know it's hard to believe right now, but there's going to come a time when gold and the miners hit bubble territory. Now these are highly cyclical types of stocks and they're not going to go up forever. So there is a time when they're going to hit bubble territory and then come crashing down. And so it's useful to know what the environment is like, what the charts look like when we are in the bubble, and what are the signs that a bubble is going to pop. Before we move on, I'd like to start with a viewer advisory warning. So this video may not be suitable for all viewers. It contains technical analysis themes, charting scenes and statistical language that may offend some people. So viewer discretion is strongly advised. And the reason that I say this is that we do get some occasional passers-by who hate technical analysis and they freely comment about how useless and pointless it is. But then why are you watching these videos? Go away! It reminds me a bit of when you buy a packet of peanuts and on the packet it also says may contain nuts. We've really got to the point where things really do have to be over-explained. Anyway, I think we could probably have a little joke about this. So if you see anyone in the comments section writing about how useless technical analysis, don't bother discussing or explaining to them. Just say it may contain nuts and we can all have a little laugh about it. So let's get started with a little bit of theory, and this is the theory that shows the 4 phases of an asset bubble. And in this video we're going to concentrate on the last 2 phases. That's the mania phase and the blow-off phase. So that's this area of the chart over here. And we can see that we start off with greed and that moves into delusion, and you see a very steep rise in price. And at the top, everyone talks about the new paradigm. Then as prices drop, people go into denial, oh, it's just a correction. And then you get this bounce, which is a bull trap, and people start to wonder, oh, things are back to normal, we're on the move upwards again. And that's when it gets smashed down and we enter that fear and then capitulation stage. As prices continue to storm upwards before we get to the top, the important thing is that most people don't actually see that it's in a bubble. Prices have gone up for so long and to such high levels that people start to develop a false sense of security. And it's quite common to hear those words, it's different this time. You also see people ignoring bad news, and so you get a disconnect between the price and the intrinsic value and fundamentals. You also start to hear about these celebrity stocks, which the media raves about and talks as if they're magic cash machines. But the important thing is that you do see smart money selling near the top, and you get increasing numbers of retailers buying in. And this is actually quite an interesting indicator. Certainly from personal experience, I've noticed that when you start to hear from someone who has never really shown any interest in investing before and certainly doesn't have any personal experience or knowledge of it, when they're going around starting to give stock tips, you know that there's trouble ahead. And I can think of a few examples of that I've actually experienced myself, and that kind of backs up that whole shoe shine boy quote from the Great Depression. If we're talking about the precious metals sector, then a good indicator of whether retailers have gone nuts over precious metals is when channels like this get hundreds of thousands of subscribers. So once prices peak, that's when the drop begins. And initially you'll hear a lot of denial about this, and interventions are quite common at this stage. So as things drop further and further, usually the first drop is actually quite dramatic and rapid, as we'll see coming up. But interventions, as I said, are quite common. So, for example, when they had the tulip mania in 1673, the Dutch government actually stepped in to try and stem some of the drops in tulip prices. But in the end, that actually only made things worse. Another example is during the Great Depression, when banks and various financial giants bought large quantities of stocks at above market prices in an attempt to stabilise the market. But none of these interventions were effective in the longer run. In the shorter run, they may have helped prop up prices, but in the end they ended up failing. People often talk about a return to normal. Maybe the prices are going to go up to new highs, and all that's happening at the moment is cooling off for the next rally. However, as that initial optimism starts to wear off, things turn to anxiety and then fear. Having gone through some of the psychological aspects of bubbles, let's move on to looking at the technical aspects by looking at various examples of charts of bubbles from the past. So we'll go way back to the tulip mania of the 1600s. And of course, in those days, they didn't have the high degree of data that we've got nowadays. So this chart is pretty kind of coarse, I guess you could say. But there are a few things that we can gather from this chart. So the first thing is that initially prices rise slowly, and then when things go parabolic, they go pretty high, much higher than anyone would expect. But when they drop hard and actually go back to at least the level where it began to go parabolic, if not lower. Moving on to the South Sea stock bubble, and this is an interesting chart. Again, we see that prices rose. They had a little bit of a kind of consolidation over here, and then you've got this parabolic rise. It's almost vertical on this chart. And then, of course, prices drop. There's a little bit of a bounce, and then they just completely plummet, and it goes back to roughly the prices where it started to go parabolic. This chart has been annotated by an interesting story, which goes to show that just because something's in a bull market doesn't mean that profits are guaranteed. So if we look here, this is actually Isaac Newton who actually got involved in this stock. So he invested a bit when prices were relatively low here, and prices went up. So he actually doubled his money here, roughly, and so he was pretty happy with that. But of course, then he saw prices rise further, and so, of course, he started to think, oh, I'm missing out. So that was when he started to get FOMO. And the other thing is, of course, everyone around him is talking about how rich they're getting, and he's feeling pretty bad that he got out early. He doesn't remember that he actually doubled his initial investment. And of course, as prices just kept going up and up, you start to wonder, oh, is this just going to keep going up longer term? And the psychology of that is what actually occurs. And as a result, he re-entered. And he actually invested a lot more than he did in his first investment. And that's another common thing that occurs. So he upped his bet, and of course prices went up, so he was initially happy. And then when they dipped down, he probably would have thought, oh, it's probably similar to that dip that occurred during his first investment. But of course it wasn't. And prices plummeted and he exited, and so he would have lost a about 70%, 75% or more of his second investment there. And he actually ended up exiting broke there. Another bubble was John Law's Mississippi Company bubble. This graph is not so clear cut here. Remember that we're over a very short time frame, so this is actually over just under 2 years. We can see that prices went up, but this top here isn't very clear. I'm not sure what's happened in this area here. Again, information would have been difficult to get hold of, and plotting data might not have been quite so precise as we've got nowadays. So again, the only thing we can gather from this is that prices went up pretty steeply from less than 1,000 to 10,000, and they dropped pretty rapidly. So first of all, you got an initial rapid drop, then you got this bounce, and then you've got a slower decline after that. Let's move on to the Great Depression. So this is the crash of 1929, and this is a chart of the Dow, and we can see prices were rising steadily. There was a little bit of consolidation here, then we had a much more rapid rise up here. Again, a little bit of consolidation. So we've got these 3 peaks here, and then you get that final burst upwards. And so one of the things to note here is that first decline was very sharp and rapid. You got a tiny little bit of a bounce there. Then prices went down hugely and bottomed over here in roughly October 1929. Then we had a rise, and the rise was actually pretty strong there, and that was probably related to that intervention that we talked about earlier with the banks and the financial giants there. And that was not sustained. So on this chart, it didn't actually even reach that area of consolidation over here. Let's have a closer look at that chart. So again, here's that first drop. We've got a little bit of a bounce, big drop here, and then we've got this wedge pattern over here, and prices just poked out of that wedge before diving down. But again, remember, it didn't go straight down. There were bounces. So again, there's a smaller wedge over here, and then another drop down to close to the previous bottom. And a lot of people probably would have thought that prices were going to bounce up. So many people might well have bought into these rallies here, only to be disappointed with further drops going onwards there. So those are some historical examples, but let's move forward in time closer towards where we are. And so I'm going to go through a few other examples of bubbles, and in these upcoming charts I'm going to have a small box giving a kind of broad overview of what the bubble looks like. So it's usually either on the weekly or monthly scale, and then the main chart is going to be a close-up on the daily scale showing what's going on. And of course, let's start with gold, which of course was in a bubble in the late 70s, early 80s. And if we look at the overview here, we can see that prices started rising. We had a little bit of a consolidation over here, and then that's when prices really shot up. That was a parabolic move. So one of the things we really want to look for towards the end of the bubble is a parabolic move. So on this daily chart, you can see that more closely, and this parabolic move seemed to kind of be in 2 phases here. So you've got a kind of bull flag there before the next vertical upwards movement. The difficulty is knowing just how far that parabolic move is going to go. Timing the absolute top of that is pretty difficult. I think people who say they did catch the exact top probably just got lucky. And the difficulty is, of course, that when it turns around, it can turn around very, very sharply. So it can come down just as fast as it went up. So we can see here that the first drop actually brought us back to that top of that bull flag there. On the way down, bounces do occur. So here we've got a channel or kind of bear flag that's formed before the next drop. And again, you've got on a much larger scale what looks like it might be a channel. And once it broke down below that channel, that's when prices just declined. Next, we have the Nasdaq or .com bubble. So if we look at the overview here, we can see that prices rose steadily. Then we went through this consolidation phase before going through a massive rise. So again, that massive rise seemed to occur in two sections. So we had the first rise, then some kind of consolidation. Instead of being a kind of downward sloping bull flag though, this time we've got an upward sloping kind of channel. And then we got that second big push up there. So looking at it in a more close-up way, this is on the daily scale. So this is that upward sloping channel that occurred over here. And this is that last push up there. And in that last push up, you can see again, we've got those couple of bumpy areas here before making that final move up. So in this one, we've actually got a double top that's occurred here before it drops down. And once it bottoms here, we see that it's formed a upsloping wedge. When it broke out below that wedge, prices didn't really reach anywhere near that previous bottom, but instead actually bounced up to form another little double top before moving downwards and making new lows. And again, prices kind of went back to roughly where the parabolic rise began. So with this, we can see that there are some patterns that are emerging if we're comparing different bubbles. But let's keep going. This is the Japanese stock index, so the Nikkei 225 index back in the 1990s. And if we look at this overview, you can see again that this index rose pretty rapidly. This rise does look a little bit different from the previous ones that we mentioned. I guess there is a bit of an area of consolidation over here and then a smaller one here between those two big rises there. And if we just look more closely on the daily scale, so this is the top here, which corresponds to this bit here. And the other thing to remember is that these examples do show how things can look different depending on what scale you're looking at them. And so it doesn't look so bad when we're looking at it on the daily scale compared to on the weekly scale, but these are actually the same charts. And so again, we saw an initial drop. There's a little rising wedge that's formed here, which again broke down, tried to retest up there and then broke down again. And then when it bottomed, again, it formed this rising wedge. When it broke out of the wedge, it only partially fell before trying to make a double top here. And then prices plummeted after that. But the difficulty here is that what about when we were in this section here on the overview? How did we know that that wasn't the end of the bubble? And that's one of the difficulties. It's very easy to look in retrospect and you could say, well, we're just cherry picking the bubbles. So, you know, I admit that it's much more difficult to look at these things prospectively compared to retrospectively. And we've got a few examples of how that's difficult coming up. Next, we have the Shanghai Composite Index, which formed a bubble in 2007. And here you can see this is a real classic parabolic rise. Again, we've got two areas of consolidation, one over here and one over here, but it didn't really consolidate for very long but this last push up was huge, and that's because these moves are so rapid and so large. That's what draws a lot of people in, and particularly the retailers can get caught up in that. So if we look at that on the daily scale, what happened? We seem to have what looks like a double top here. This is the consolidation that occurred before we made that second push up. It looks like a bullish triangle there. So once the double top had occurred, prices dropped, and again it looks like we got a little wedge. It poked out above that a couple of times before plummeting, and it didn't really bother to even go back up again to form a double top like in the last example. It just went straight down and kept going, and again it went down pretty close to where the parabolic move had begun. What about Bitcoin? So this is a much more contemporary example which occurred relatively quickly compared to some of those other examples. Again, we've got this real classic shape parabolic move. There's a couple of areas, probably three areas. Well, the first move probably began after this area of consolidation, but we had one little area of consolidation over here, and then prices moved up quite substantially, consolidated significantly over here before making that massive move up over here. And on the daily scale, this is that massive move up from 6,000 up to almost $20,000 there. And before making that very last push there, you can see a little area of bumpy movement that we mentioned earlier. So after prices peaked, they dropped pretty dramatically here, and then it looks like it's formed a bear flag before continuing its decline. And again, prices seem to have gone back to where that parabolic rise had begun. And finally, we have an example of uranium company. This is Paladin Energy, which made an amazing move. So down here it was priced at 1 cent at some times, and it just stormed up and went to almost $10. That's a massive, massive return if you got in at that 1 cent level. Again, the chart is pretty similar to the ones we mentioned earlier. So you've got this parabolic shape to it. There are areas of consolidation. This is actually quite similar to Bitcoin in some ways. So you've got a little area of consolidation here, a second one here, and then you've got a big rise, then another area of consolidation here before this last big rise there. And looking at it close up, you can see that we've got some consolidation here, and then another one over here. And this is that last big push up. Now, the problem here is that if you were actually looking at it in real time prospectively, you know, this would have looked like a big move up. And when it started dropping, then you may have thought, is that the end of the bubble? There's not actually an easy way of knowing whether that's the case. And of course, you know, when prices bottomed, they started to rise up in this flag shape. And again, it broke down, but actually that didn't continue to drop. It actually just kept storming up to make new highs. So although it's easy to look at some of these patterns retrospectively, this just goes to show that there are no guarantees. And when you look at them prospectively, you're not going to know whether you're at the top of the bubble or not. And that's part of the reason why it's worth looking at some of those psychological elements as well. So looking at how this one progressed, it formed a double top and then broke down quite substantially here and then had another rally. And so people may have thought, oh, we've got this situation again and it's going up to $20 or $30. But unfortunately, that was not the case at that time. And prices just plummeted below that level and continued to fall. And on this chart, again, it shows that prices went actually below where the parabolic move started. So the aim of looking at all these charts is to really show you examples of what bubble rises and pops can look like. And there are certainly some recurring patterns that we see, but it's also important to remember that these patterns are only obvious in retrospect. As you're actually in real time looking at these bars, it's not quite as easy as that. And there are times when bubbles can be called prematurely. So I don't think chart patterns alone will tell you whether you're in the process of a bubble burst or not. You really need to combine with what you're seeing around you, what's the psychology of the environment. But also it's important to just be aware of what's going on and manage your position appropriately. So for example, in the case of Paladin, if someone had bought at a few cents down here and had managed to ride things up to say $5, then you would want to be kind of taking profits as prices rise, expecting to get out exactly the top. It's just luck, really. I don't know anyone who's consistently able to do that. So next up, the market update. Let's start with gold priced in US dollars on the weekly scale. And yet again, not a huge amount has happened in terms of the gold price. So for the past 2 months that we can see that we've really been moving sideways. But that's not necessarily a bad thing. This is giving gold price a bit of a breather. And actually, the longer it stays up at these kinds of levels, then the higher the lowest price point is going to be, because we've got this upward sloping trend line here. It's hard to know where we're going to go from here. We're certainly at the upper end of that sideways trading range over here. And it really depends if we can break through there. But remember, there's not a huge amount of headroom at the moment because we do have strong resistance at around 1800 at the moment. That dates back to around the 2013 level. So if it does poke above this trading range, then I think 1800 would be formidable resistance and we could see a bounce back from there. However, if we can't make it above here, then in the coming weeks we may see further consolidation. So we may continue around here before we move up. And remember that we're looking for possibly a handle forming because we've got that cup and handle potential structure. But remember, a handle doesn't have to form. Price could just blast straight upwards from here. Personally, I think a bit more cooling off is needed. Whether that happens from the 1800 level or from here, it's hard to know. But I'm not expecting any catastrophic drops here. And we're looking at most likely the support is going to be in the region of this upward sloping line, so above the $1,650 level. But there is the potential for a slightly lower drop, in which case we're looking at the around 1,550 level. But as I said, the longer it stays up here, the higher the lowest level is likely to be. And I thought we'd also take a look at those gold lease rates that we talked about in my video comparing the current times to 2008. And you'll remember that back in March, the gold lease rates went as low as -6%. So that basically means that if someone owned some gold, they would have to pay 6% to lend it to someone, which sounds very, very strange. And this is highly unusual. This cooled off a little bit for a while, but again, back at the end of May, it went back down to -5%. And again, it's cooled off a little bit. So at the moment, it's at -2%. And this is all very unusual. Normally, certainly in 2008, these lease rates are actually highly positive. So what we're experiencing is something quite different to what we've had in the past. And certainly if you look at longer term charts, these haven't really been anywhere near as negative as this. Let's move on to silver in US dollars on the daily scale. And we've been talking about this kind of channel, upward sloping channel, and our bullish signal, major bullish signal, is just above the $19 level. But we've still got some resistance overhead at around 1850. And certainly this resistance seems to be holding. But we're also been skirting along the lower end of this upward sloping channel here. And it's tested it a few times now. And you can see that we've got long wicks on the top of each of these candles, which to me makes me think this is looking a little bit weak. It keeps banging on that floor there. So if that floor does hold, then yes, potentially this could go up, but I'm not so sure. I'd be probably more confident if price were to break around, say, the $17.90 $17.90 level. But if we break below that, I think we've got pretty strong support here, just above $15. So we really need to watch that upward sloping trend line to see where it goes. Now, looking at the lease rates, we also have silver lease rates, which are behaving even more strangely than gold. So here we can see that in April, the lease rates went as almost to -4%, and that settled down. It went to 0, but then it went back again to almost 4%, and it's at the moment it's around -3.5%. So this looks quite different from what we're seeing in the gold lease rates. And again, if you look at the historical charts, it's very unusual for silver to be in this negative territory. I'm not sure what's going on here, but to me, this suggests that silver isn't behaving just as an industrial metal here. I'd be interested in hearing if anyone's got any interpretations of what's going on here. It's a very, very interesting phenomenon. Let's look at the GDX on the daily scale. And we've got this line here just around 32, which has been a 7-year resistance level, which we broke through back in roughly March. And I was a little bit skeptical of this breakout. However, it did continue to rise to 38, but then since then, it's been a little bit weak. What's going on here? Is this just going to bounce off of this 32 level? Certainly the 32 level would potentially be strong support. But in order to be bullish, we would have to see a breakout above this downward sloping trend line. So certainly it would have to close above 34 to consider a move up to around 40. What is the formation that we're seeing here? Does that provide us with any ideas about where this price is going to go? Well, there's a couple of possibilities here. One is that we've got a descending triangle. And if that's the case, that tends to be bearish, in which case any break and close below around the 32 level would signal a downwards move, and the target would be around 26 here. But the other possibility is that we've actually just got a downward sloping channel, and this could be a flag formation, because obviously this was a very steep and rapid rise. So this could potentially be a bullish flag with a breakout upwards. So it's very difficult to know which of these is going to occur, and so you would have to base your trades upon the breakout of those lines. And of course, the GDX is very highly linked to what the gold price is doing, so it depends where gold goes from here. I also thought that we could look at the GDXJ, and this is on the weekly scale. And the reason I'm looking at this is just to show you one of the reasons why I was skeptical of that breakout in the GDX. So if we look at the GDXJ on the weekly scale, what I did was joined the peaks over here and over here, and that actually ended up showing that that's a resistance level, and of course it pretty much bounced off of that quite nicely. It tried to poke over a tiny amount but then was rejected. Of course, we know that the GDXJ does lag the GDX. Usually the majors make the first move if it's in a bull market here. So although the GDX broke out above its long-term resistance line, the GDXJ did not. And we've got a couple of possibilities here. Again, this could be a flagpole and we're just forming a little bit of a flag, in which case we would want to see a breakout above this flag. But remember, we do still have resistance here. So we'd really want to see a breakout above 50 to be more confident that we're steaming ahead here. If we do move downwards, then I would expect to see some support around this level here. So that's roughly 37.38. And there's a lot greater support here at around the 32.33 level. And that dates back from quite a long time there. Let's look a bit more closely at the GDXJ on the daily scale. And this is the rise that we saw in March. You can see that this resistance line was rejected here and price has been just slowly moving downwards. It's been nothing dramatic here. That upwards move could be interpreted in one of two ways. So one, I've drawn the lower line, which I think we can all agree on there. But which of the upper lines do we use? One possibility is this one here, which means that we've got a rising wedge. And so if we do have a rising wedge, then here it popped out the top and then fell back down to retest the bottom of the wedge and went up again, but couldn't really make it even to the top of that wedge line before falling down. We had the breakout below the wedge here, and price then went to retest the bottom of that wedge, but that failed, and then price is moving down. That's one interpretation of it. Another possible interpretation is that we've got an upward sloping channel here. So we're looking at this trend line here, in which case we've still got a breakout below that channel. And so the target price would be the height of that channel. So again, we're looking at a potential drop to around that 32.50 kind of level. And that, if it did fall to that level, of course, it would close the little bit of a gap that we've got over here. But of course, it could equally move upwards, in which case we would need to really watch the top of this trend line here. So a break above, let's say 45 really, 45-ish. But remember, the 50 would be a potential resistance level there. So overall, I'm still favouring a bit more downside, but as I said, it's not going to be anything catastrophic for the miners. And certainly when we're looking back at the GDX, the fact that that ceiling cracked suggests that the next time that it has a go at it, it's just going to smash that ceiling. That's my suspicion. So I see any drops as a potential buying opportunity. So that was a bit of a long show today, but I hope it was of some value to you. That's all from this week. All the best and see you next week. Bye.